Good evening, everyone. Time for another silver update. This is the daily chart of the Dow provided by netdania.com. You can click on the link below. I've drawn some lines here, the major trend line, of course, and then there are the MACD trend line and a secondary MACD trend line. You can see that we're approaching this trend line on the downside. We had a very large move down in the Dow after the Obama re-election. We're also about to cross over on the downside. We're in negative territory. So what does that mean? As I said before in my Kerry Lutz interview, that I'm not so interested in what the results of the election is as much as what the market's reaction to the election is. Now you can see that a very clear reaction came about after Obama was reelected, and in my opinion, this is going to be related to the potential capital gains tax change. So at the present time, you're looking at a very low capital gains tax. Correct me if I'm wrong. I think it's 15%, potentially going as high as 39% if there is not an extension of the Bush tax cuts, which are set to expire. So it looks like Obama is going to be put up against a wall by the market. And is he going to extend those tax cuts again, or is he going to let them expire and let the taxes on capital gains rise? That's very important because a very large amount of money that was made under the Obama bull market, and you can see very clearly this is a bull market from the bottom in March of 2009 all the way to the present, a significant bull run, and one that it would be very difficult to lose the election with this type of performance. Was the Fed behind this? I think you could have to say that yes, the Fed was behind this. But will this continue for the next 4 years? Now, Democrats tend to have better records as far as stock market gains. That's kind of counterintuitive. But then again, it's not, in the sense that the Republicans at least have mouthed the tendency to have some kind of fiscal restraint. So with these election results in, with Paul Ryan not even able to carry his own state, and I believe it was his own county as well, it was unable to carry. What does this mean? Well, we're going to find out real quick because this trend line is about to be penetrated to the downside. So is the market going to force Obama's hand in this, and the Congress's hand? And we know that pretty much the election results were that there was no change at all. And so what's going to happen on this? Now, anecdotally, you have the machinations of the people who were talking about 401k reform and about making retirement some type of secured thing with government bonds. Now, we know that's not going to fly if we have a bull market in stocks. So if this turns into a bear market and we cross this line and start going down significantly, will it be possible for them to make the argument that stocks have failed the people as a retirement option, and then we need to go to some type of guaranteed retirement with government bonds? Of course, then what that's going to mean is that they'll be able to take all of those trillions and move those into government bonds and secure the debt in that way. So that's a very interesting question. We don't know. We're going to have to wait and see what the chart does. Silver, of course, is very undecided. It's had some violent up moves and down moves. If we go to the 1 minute chart, we can see we're rallying now in the after hours. We had a big spike and then a drop off. So the the precious metals, for the most part, are undecided, but there's a lot of volatility. We'll go over to the gold chart and see that we're doing the same type of volatility that we had with silver. We got to a new high, and then we got to a new low, and now we're in the middle. So we'll have to wait and see how that concludes. Now, Apple stock, that's one I've been covering very closely because that's kind of the leader of the bull capital gains players. You can see that the drop off in Apple was very dramatic, and it ended at a very, very bearish situation. You can see you have a gap down and a very weak attempt to test it. It didn't even make it back to half of the price drop, much less getting back into the gap. So it looks like Apple is beginning a free fall. Now, we know from the long-term chart that Apple is definitely a bubble, so I've been predicting for a very long time that Apple would be cut in half and more, probably cut by 2/3. So we're looking at something down around $200 a share for Apple. So there's a long way to go on this going down. Now, let's get to the questions of the night. First question is from ICCO3766. And he asks, Brother John F., I've started following the silver movement. I've been watching your videos. Very informative, and I've learned a lot. I'm going to start building my physical silver investments. I've been on just about all the bullion dealer websites and see so many different choices as far as bars and coins. Does it make a difference what you start collecting? Is one round more valuable than another round? Is the APMEX brand better in the long run than, say, Scottsdale brand or Pan America? Or is it all the same no matter what company has their stamp on it? What else should I be looking at when I'm collecting physical silver? Keep up the good work. So, obviously, he's looking at just the rounds. There are various rounds issued by these mints. You have APMEX brand rounds, you have Scottsdale brand rounds, you have the Pan American silver rounds. So he's looking at those rounds. Of course, those are going to be very close to spot, not much of a markup. Now, I haven't covered those because I like to cover the semi-numismatic coins, and sorry about that. The semi-numies have a significant premium above spot when you're talking about compared to these rounds. But then again, the silver eagles are roughly $2 to $3 above spot, and so are the rest of the named or known mints. So if you're looking at the semi-numies, you're looking at about $1 over those named mint prices, and so that's going to be a choice you're going to have to make. Now, if you're looking at just getting into the game, I think that you might want to just look at the junk silver. That's going to run very, very close to spot or just a little bit above. Sometimes it actually trades below spot. That's going to be a choice you're going to have to make based upon what you think is going to happen in the future. Now, if you believe that silver is going to explode to the upside and go to unbelievable and phenomenal prices, then in my opinion, it's in your interest to look to the named mints, the known mints, and the numismatic, semi-numismatic coins that they issue. Yes, you're going to pay $1 above eagles, but then again, you're going to have a coin that is going to be very highly unlikely to be counterfeited. My favorites, of course, are going to be the Perth issues. Those also have the benefit of coming in an individual sealed plastic container. That's one thing that the Perth has above everything else. And if you're going to try to resell them as Numies, you're probably going to have the ability to sell a non-graded, but potentially to be graded MS65 or MS70 coin. That's really the big advantage of the Perth. Now, you have the RCM with the latest one, the Antelope series, and that may be like the Wolf series and get a very big boost on the numismatic, but that's a gamble. So, in my opinion, if you're just starting out, probably the junk is the way to go, and then you're going to start wanting to look at semi-numies. That's just my opinion. Of course, that's not investment advice. And next question from FL Headhunter. Just who are the manipulators? If the CFTC allows gigantic shorts such as the one this week, it's pretty obvious that the government, COMEX, and or JP Morgan et al. Are in cahoots to some extent in the manipulation of silver. When the thought occurred to me at about 3 a.m. this morning that the government is furiously creating money, the implication is that there is potentially unlimited dollars available for the big short sellers to play with in their shorting endeavors. How do these shorts ever get covered? Do they? And if they do, it would seem to me that it won't be long now before the price indeed does skyrocket. Am I reading this right? Well, those shorts don't have to ever be covered as long as there isn't some type of crisis in the futures market. For the most part, futures shorts are rolled over to the next contract or out to a few months or years in the future. They simply sell the existing contract and buy a futures contract. So they sell their long and buy a new long out in the new months. That's the way the futures work. You don't have a cash price as far as the futures go. You have to continue to roll those contracts. We've seen that for the longest time, that the shorters in the silver market have continued to roll their contracts over into the future months. And so that's not really relevant to when the game ends. Now, the question, I think, gets to the issue of when the game actually ends. Now, that is going to come down to how serious they are about shorting to the very point of physical failures of delivery. So, in theory, it's possible that they could short silver until the last ounce is not available to be delivered, and then there's some type of default scenario on either the COMEX or the LBMA, and then you go to cash settlement, which they already have the rules for. Now, the question is going to be is what happens when that happens. So if they change the rules, or if they announce that they're going to the new rules that were now in cash settlement, that they're not going to deliver on the physical metal, then the question is what happens to the physical market, and that's anyone's guess. That could happen at any time, but then again, it seems that they're very interested in drawing the situation out as long as they possibly can. Of course, there's that 750 million ounces per year that come online. Not that much is taken by investors. A very large chunk is taken by industrial users. So when are the industrial users going to end up being pitted against the physical silver buyers for bullion? That's the million-dollar question. We don't know when that's going to happen, but the projection is that at some point in the future that's going to happen, where there's going to be a bidding war between the people who are investing in physical silver and the people who are consuming physical silver in industrial uses. When that occurs, that is probably going to be when that price explosion happens. We don't know when that's going to happen. So let's get to the main story of the night. I want to cover the article from Gary North on his blog about Intrade and the election. Now, the election was called by Intrade for a long time. The Intrade odds were never in doubt. Obama was in the lead. On election night, I checked it multiple times. The percentage was 70% Obama, 30% Romney, and we know that that's what it turned out to be. So the question is, why was Intrade right? And that's something that Gary North goes into, so we're going to read this here. Polls, all that money, so little usefulness. Intrade betting for months has conveyed the same story: Obama would win. The Democrats would take the Senate and the Republicans would take the House. The Republicans had a chance in the Senate, but they blew it big time. The reversal came with Todd Akin's bonehead statement about rape and pregnancy. The dominoes started falling. Intrade said the Republicans had a 20% chance to take the Senate on the day of the election. You can see he's posted that chart there of the Intrade chart. You can see at one point in 2011, Intrade actually projected that they had an 85+% chance of doing that. It collapsed. The House was equally secure for Republicans. There was the article on 8 conservative pundits who predicted a Romney victory. They look silly now. Peggy Noonan said Romney would win based on vibrations. She writes great speeches. As a political forecaster, she's silly. The polls are silly. The polls are economically useless when competing against Intrade and other betting sites. Intrade knew, the polls didn't. Once again, the law of large numbers works. The wisdom of crowds works. We have known this for over a century. It goes back to Darwin's cousin, Francis Galton. Wikipedia describes his discovery, and we'll skip that. But we don't believe him. We keep thinking that scientific polls are scientific, i.e. better at determining the outcome of a contest than betting is. That is bad science. Drudge kept running these poll results in headlines, and you can see it was a very tight race according to Drudge. The popular vote was close. It was inside the margin of error. That's another way of saying stop polling. The margin of error on Intrade is much smaller. Polls are expensive. Intrade costs us nothing. As long as we do not bet, we ride on the findings of really silly people, i.e. people who bet money on outcomes for the sake of the game. They do not have to play the game, but they do. They put their hard-earned money on the line when there is no need to. But bettors serve a useful purpose. They let us forecast outcomes more accurately, especially in head-to-head outcomes. The more bettors there are, the more likely they will forecast the outcome correctly. When the betting is tied to a non-game event, the information it generates is useful, far more useful than an expensive scientific poll. As you can see, I never doubted Intrade's results after the Senate fell from 53 to 47 for the Republicans to 20-80 against. There was no margin of error worth talking about in any of the 3 betting markets, President, Senate, or House. There comes a time to face up to reality. The reality is this: the polls are no match for the accuracy of betting sites when a large number of people are betting. All of the money spent on polling was wasted. All the emotion spent on assessing the polls was wasted. One woman canceled her subscription to Tea Party Economist. She said, I had a choice. Either I stopped predicting an Obama victory or she would cancel. I removed her name. Reality intrudes with Intrade. She did not want reality. She preferred a week of fantasy dreaming. She would not allow reality to intrude. This is common. Think of the present value of the unfunded liabilities of Social Security, Medicare, and Medicaid. $222 trillion. The media do not focus attention on this reality. Congress ignores it. Of those few American families out of 100 million who have heard this statistic, most do not make systematic adjustments in the plans for the future in terms of that reality. They will not allow reality to intrude. Reality will intrude. So, excellent article by Gary North. We know now that Intrade was right all along. These were real people betting with real money. And of course, what that means is it was a market. It was a market of people who were betting their own money onto how they thought things would turn out. And now it turns out that the market was very right, and the pollsters and all the rest were very wrong. So Intrade had it right. Now, what does that mean? Well, it means that markets tend to have things right because markets are the essence of all the votes added together. They are a complete picture of all the players putting real money on the line. These are real people betting real money, and you can see that markets tend to be more correct than pollsters or any of the others. So what is the market predicting? The market is now predicting that if Obama does not extend the tax cuts, especially tax cuts to the capital gains, and that will specifically impact this Apple stock. You can see on the chart that Apple is still in a bubble formation. We have a very long way to go for this stock to correct. And the question is, will the market predictions of the players in this game, will they be correct? My guess is they will be correct, and that if Obama does not move on making some kind of change in the potential capital gains tax, then you're going to see a tremendous sell-off before the end of the year, because people are going to try to sell and lock in their capital gains at that low 15% rate before taxes go up to, we don't know even what rate they're going to go up to, potentially a tripling of those capital gains taxes. Now, we know that Apple returned 100-fold. It went from a low of $700 to $700. So you can imagine every $10,000 invested resulted in $1 million. That's going to end up being, under the current capital gains structure, a $150,000 tax on that $1 million gain. But if it turns out that capital gains taxes go up threefold, then you're talking about a $450,000 tax bill on that $1 million capital gain. So a big difference. It looks like the stock market is going to call the bluff of Obama and Bernanke, and we're going to see who blinks first. And we'll talk to you next time.